Hi there, welcome back to another Dividend Deep Dive video about Mindshift Theory. Today we are taking a deep dive into one of the most recognizable brands on the planet. Today we're going to be looking at Google, ticker symbol GOOGL. Now let me start by asking you a question. When was the last day that you didn't use a Google product? Whether you're searching for information, whether you're watching YouTube or checking your Gmail, whether you're navigating Google Maps, storing photos in Google, or backing up files on your Google Drive, whether you're downloading apps in Google Play or scheduling meetings in Google Calendar, or using Gemini for some deep research, Google has become a part of everyday life for billions of people around the world. And that is exactly why companies like Google deserve a closer look. Now, Google was founded way back in 1998, and think about that for a moment. Do you remember where you were in 1998? Maybe you were at school, maybe you started your first job, or maybe you hadn't even been born yet. Back then, the internet looked completely different. Very few people could have imagined that this small search engine company would grow into one of the most valuable companies in history. Now here's something that surprises many people, right? Google only started paying a dividend in 2024. Right now, that's only 2 years ago. That means that it's still very, very new to rewarding its shareholders with regular dividend payments. But so far, Google has increased its dividend by 5% each year. And that's encouraging because it shows that management is committed to returning its shareholders with a small part of its enormous profits. At the moment, Google's dividend yield is about 0.28%. Now that might sound low, especially compared to dividend yields of some other companies, but let's quickly explain what a dividend yield actually means. A dividend yield is simply the amount of dividend that you receive each year compared to what the current share price is. Think of it like this. If you buy a share for $100 and that company pays you $1 per year in dividends, your dividend yield would be 1%. It's $1 over the $100 cost of the share price. It's simply a way of measuring how much income your investment pays you each year relative to the price that you paid for it. And in Google's case, the stock price is currently $320 per share, and the company pays 88 cents in dividends this year, and that makes the dividend yield 0.28%. Now, a lower dividend yield doesn't necessarily make the company bad, and a higher dividend yield doesn't automatically make it a good one. The important thing to understand is the whole picture, right? Is the company growing? Can it afford to keep paying dividends? Will those dividends likely increase over time? Those are the kinds of questions long-term investors ask. Now, one mistake that new investors can make is by buying stocks when everyone else is excited about them, when the headlines are positive, when everyone on social media is talking about the stock, and when the chart is making new highs. And that's when people feel safest about buying, right? But ironically, this is usually when the stock price is at its most expensive. And what we're looking for is when there is a pullback in price, because a great company doesn't always make a great investment if you are paying too much for it. The price does matter. With Google right now, the price has actually fallen more than 20% from its recent highs. At the time of recording this video, it's trading at about $320 per share. Now, could it fall further? Absolutely. Nobody knows where the market will go tomorrow, or next week, or next month. And anyone who tells you that they know exactly what's going to happen probably doesn't. But when quality companies become cheaper than they were before, that's often when long-term investors start paying closer attention. Not because it's at the bottom, but because the value has become more attractive. And here's something that I wish I knew when I was a beginner investor. You don't have to buy a huge amount all at once. If you believe that Google will still be around in 10 or 20 years, you could simply buy one share. That's it, just one. If that's what feels comfortable for you, that's perfectly okay. And if the price drops further, you can always buy another share later, lowering your cost base. lowering the average amount that you own Google shares at. That's called dollar cost averaging. It's called building your position slowly over time. Instead of trying to perfectly time the market, you're gradually investing at prices that you feel comfortable paying. And remember, even if you own only one share, you still receive the dividend payments. Every share is treated equally. And here's how I like to think about it. Maybe there's a premium brand that you really love. Maybe it's your favorite pair of trainers or your favorite coffee machine or your favorite laptop. If that product was to suddenly go on sale, would you avoid buying it because it's cheaper? Probably not. You'd probably think, that's a really good bargain, right? And for me, investing can work in a similar way. When high quality companies become cheaper, I start paying more attention. Not because they're guaranteed to go straight back up, because I'm potentially buying something that I already believe has long-term value. And that's exactly what we do here at Mindshift Theory. We don't tell you what to buy and we don't tell you when to buy. Instead, we teach you how to make those decisions for yourself. Because once you understand how investing works, you no longer have to rely on someone else's opinion or follow influencers or chase the latest hot stock. You'll have the confidence to make informed decisions based on your own research and your own goals. And that's a much more powerful place to be, because if the stock price does dip down further, you're in a better position not to panic and to hold because you know why you've made the decisions that you have. The stock market can look like a scary place when you're first starting out. The charts move up and down and the news is full of drama, and everyone seems to have a different opinion about which way the stock charts are going. But investing doesn't have to be complicated. And when you simplify the process and you focus on great businesses, when you invest patiently and think about the long term, you're using the very same system that quietly creates millionaires every single year. It doesn't mean that every investment is going to be successful immediately. Nothing is guaranteed. But learning how to think like a long-term investor can completely change the way that you see money and wealth. If you found this Dividend Deep Dive video useful, don't forget to like the video, subscribe to the channel, and let me know your thoughts in the comment. Would you consider owning Google for the next 10 or 20 years? I'd love to hear your thoughts. Thanks for watching. I'll see you in the next Dividend Deep Dive video.